The syndication investing landscape has changed. You may have heard stories of LPs getting burned by bad deals as of late. You may have also heard about investors steering clear of syndications altogether. Yet there are still testimonials floating around of how this form of investing is still profitable. So what makes a good deal? What should LPs look for? We're going to cover that and more on today's show. Hello, Pocketeers, and welcome to Passive Pockets, the passive real estate investing show. Today, we are bringing on a general partner and a limited partner to talk about how they evaluate syndication deals. We're going to have Jay Scott, who is an author at Bigger Pockets and a partner at Bar Down Investments. Jay is an experienced investor and general partner who studies the economy and market cycles so he can make informed investment decisions. We are also bringing on Paul Shannon, another experienced limited partner and a principal at InvestWise Collective. He has invested over 1,500 multifamily units and various real estate sectors nationwide. Both Jay and Paul are currently members of Passive Pockets. Today, we're going to talk about how the market has impacted syndication investing, what makes a good operator, what makes a good deal, and sectors of the space that Jay and Paul are interested in investing in the current climate. Let's bring them on. Paul, Jay, welcome to the show.
Thanks. Great to be here.
Absolutely. Thanks, Jim. Excited to be here.
We're going to start out with Jay. Can you tell us a little bit about how the syndication investing space has changed over the past several years and why this form of investing has gone through challenging times recently?
It definitely has changed a lot in the last few years. And to explain it best, let me step back a little bit and talk about syndications in general and the three ways that investors, passive investors, LPs, make money in syndications. Number one is through cash flow. So every month, tenants pay their rent. If it's assuming it's a multifamily, we pay the expenses, and then hopefully there's money left over to both pay the mortgage and then give our investors some of that additional cash back. So hopefully every month or every quarter or at least every year, investors are making some cash flow from the deal. Second way investors make money is through what I like to call total returns. So basically you invest some amount of money up front, $25,000, $50,000, $100,000, and then when the property sells on the back end, or maybe there's a refi in the middle, you get a big bucket of cash. You might invest 100, you might get 200 back. And so you get this big bucket of cash at some point. Let's call that growth or total returns. And then the third way that syndications make money for investors is through tax benefits. So you get depreciation, you might get some money from cost segregation. The government has been giving us some benefits of what's called bonus depreciation the last couple of years, which allows us to take some potentially major tax benefits. So between cash flow, total returns, and tax benefits, that's how investors make money through syndications. The problem is that based on things that are going on in the economy, things that are going on in the banking world, based on things going on with government legislation, the amount of cash flow or growth or tax benefits that you get from syndication can change. And so just to use the most obvious example, a few years ago, interest rates were super low. And when interest rates were super low, properties would take in a lot of money and they would pay all their expenses, and then they'd pay some money for their mortgage every month. But because interest rates were low, they didn't have to pay very much for their mortgage. And so there was a lot of money left over every month for investors to get cash flow. Well, here we are a couple years later, interest rates are through the roof, relatively speaking. So every month we take in a bunch of cash, we pay our expenses, and now we have to pay a much bigger mortgage because interest rates are a lot higher, which means there's a lot less cash left to give to investors every month or every quarter. So investors are getting less cash flow. So the first big change that we've seen over the last couple years, and it's strictly due to interest rates going up, is that a lot of syndications are generating a lot less cash flow. The second piece we talked about is total returns. And what drives total returns, one of the big things is this thing called cap rates. Cap rates are just a multiplier in the market that determines the value of your property based on how much income it generates. And over the last couple of years, cap rates have gone up, which means values have gone down. And just because the economy is softening, because the multifamily and the commercial space has softened over the last couple of years, what we've seen is growth in these properties. The total returns that we're getting from these properties is lower than it was a couple years ago. So a couple years ago, we might have seen 20% annual returns or 21 or 22% annual returns. Now we're seeing 14, 15, 16, 17% annual returns. And again, that's just a function of the fact that the market has softened, the economy has softened. And then the third piece is the tax benefits. A few years ago, back in 2018, the previous administration passed the 2017 Tax and Jobs Act, which basically increased the amount of depreciation or bonus depreciation that we could take from properties. Basically, they increased the tax benefits. And for several years, we were getting tremendous tax benefits from new purchases, new properties that we were buying, and we could pass those benefits on to our investors. Unfortunately, 2 years ago, those tax benefits started to decrease. They started to get phased out. And these days, we're seeing fewer tax benefits now than we were a couple years ago. And so new syndications are generating a lot fewer tax benefits. So long story short, thanks to interest rates going up, the economy softening, and legislation kind of sunsetting, phasing out, what we've seen over the last couple of years is cash flow has slowed down, total returns have dropped, and tax benefits have dropped as well. So long story short, syndications today just aren't as lucrative as they were a few years ago. That said, a few years ago, they were a whole lot more lucrative than years past. So it really is a cycle, and we'll continue to see that cycle as the years and decades move on.
That's a great kind of summary of where we're at and where we came from. So Paul, given what Jay has said and your experience in the market, has the volatility in the changing market changed how you invest now as compared to a few years ago?
The short answer is yes. But to drill deeper into that, I mean, you really have to look at it kind of like Jay summarized, that real estate in general is a cyclical asset class. It's impacted by supply and demand imbalances, by interest rates, by local laws, by the local economy, the economy at large. So you constantly have to be monitoring your sort of investment thesis and what you have in your portfolio and where your risk tolerance is at. So for me, the change really began a couple of years ago because that's when things started to shift and you could kind of see the bubble forming in real estate. The federal funds rate was at 0 at the end of 2021, beginning of 2022. Inflation was at 9%. Up until that point, the Federal Reserve, Jerome Powell, had been talking about how inflation was transitory and was kind of going to go away on its own. But you started to see that they were backtracking on that, and inflation looked to be a little bit more structural. And they started to telegraph rate hikes. And that was going to put pressure on real estate in the form of interest rates being correlated to cap rates. So if you're in an expanding cap rate environment, and cap rates are inversely related to property values, so as cap rates go up, property values go down and vice versa. You saw what was happening in that, operators were paying a very high basis for properties. They were basing their pro forma assumptions, basically their business plan over the next 3-5 years on very short-term outcomes coming true very quickly. They were basing rent growth out into the future, being similar to how it was in 2021 when it was really a bonanza. So you just look at these business plans and you think, man, everything really has to go right for this to work. And there's really not any margin for error. And these people are acquiring and acquiring and acquiring. And at that point was when I started to change my philosophy and say, maybe I should sit on the sidelines here and observe what's going to happen, because it's very difficult to outpace an expanding cap rate by growing NOI, especially if that NOI assumption into the future is based on pro forma that's built on toothpicks and duct tape holding it together. So fast forward a year from then, really kind of sitting out for a while in 2022, started to get attractive to debt funds. And that's really where the philosophy changed for me, was looking at lenders pulling back in the market at that point. There's less supply of lenders, but there's still high demand from borrowers that were in need of financing to save their deals in some cases. But some of these deals are actually decent deals. They just couldn't find funding. In that case, you're in first position debt where you're in priority of payment number one. So the lender is the first person to get their money back in a deal. It's collateralized. So you actually have the underlying tangible real estate as collateral in the event that the borrower defaults and they can't make their payments. If it's done correctly, it's a low loan to value. So 65, 70% loan to value. Theoretically, the property could fall by 30, 35%. And the principal is still protected, whereas the common equity in that scenario would be completely wiped out. And there's actual cash flow in these deals, which a lot of investors had missed for a couple of years. And, because there's low supply and high demand, the lenders could loan out at higher interest rates. High demand and low supply, that's comes in the form of pricing power, in this case, high interest rates. So we were able to capture that and get good cash flow out of these deals. So that's the reason we were attracted to debt funds. And we thought it was a good place to hang out for a while too, because they're semi-liquid, so you can redeem these funds at some point. And when you're ready to rotate into something more aggressive, it may take 3 months, which isn't a long time. You don't necessarily want to be the first one back into the market, but if you can redeem those funds and then rotate into something more aggressive like common equity, that's a good place to earn some yield. So yeah, the investment strategy changed a little bit, and it's going to always be changing.
That's a great background, both of those answers. And so, we have some new listeners on the podcast. I want to take a step back. Jay, can you define some of the key financial metrics investors should be looking at when they're evaluating a syndication deal?
Let's go back to the framework that I was talking about before. We have cash flow, which is one benefit. We have growth or total returns, which is a secondary benefit or a second benefit. And then we have the tax benefits. And so each of those return types is going to have a set of metrics that are associated with that return. So for example, for cash flow, if you want to evaluate how strong the cash flow is on a deal, the most common metric that we use is something called cash on cash return. And cash on cash return is basically this concept of I'm deploying capital and I want to know how hard that capital I deployed is working for me. It gives us a percentage return. It's very similar to the interest calculation you might receive on a savings account or on a treasury bond, but it tells us the percentage return that we're going to get any given year on the money that we deploy. And so if you're looking for cash flow, if that's kind of the thing, if maybe you're retired and you need cash flow, or maybe you need to pay your expenses with your investments, if you're looking for cash flow, that's probably the most important metric that you're going to look at. Now, some people, they don't care about cash flow as much. Maybe they're not retired. Maybe they still have the 9-to-5 job. Maybe they have plenty of liquid savings, but they're looking to grow their investments over time, maybe 10, 20, 30 years towards retirement. They're going to care again about that total return or that growth of their investment. And so for that, we have a couple different metrics as well. Number one, we have something called average annual return, which is essentially if you take the total return over the entire investment, you divide it by the number of years of the investment, it tells us your average annual return. So for example, let's say in 5 years, you double your money. Basically, you get 100% return on your money in 5 years. Well, if you divide that 100% return by 5 years by 5, 100 divided by 5 is 20 or 20%. So 20% would be your average annual return. And so if you see a 20% average annual return, that basically tells you you're doubling your money in about 5 years. Secondary metric that's often used in this business is something called IRR, or internal rate of return. And that basically tells you how well the investment does at compounding your money. The way you compound your money better than another investment is by getting returns sooner. So if a deal, let's say you put in $1 into a deal, 5 years later, that deal returns you $2, great. Now let's say you have another investment where you put in $1 and every year you get 20 cents back on that investment. At the end of 5 years, you've doubled your money on both investments. The first one, you put in $1 on year one, got back $2 on year 5. Second one, you put in $1 at year one and you get 20 cents plus your $1 back at year 5. Again, both you've doubled your money in 5 years. But that second investment, because you've gotten money back sooner, because you're getting 20 cents every year, you can now take that money that you're getting before the end of the deal and you can reinvest it. And that reinvestment is earning money. And if that generates returns, you can reinvest that as well. And so this concept of IRR, this metric IRR, basically captures when you're getting returns back, reinvesting those returns, and basically compounding those returns throughout the investment. And so we use IRR as a great way to compare two different investments that may have other similar numbers, but we can actually take more information about when we're getting the returns to see which one's going to compound faster.
We do have to take a quick break, but more from Jay Scott and Paul Shannon on deal evaluation when we return. Welcome back to Passive Pockets. Let's jump back in. So, Paul, I want to go to you and talk about the track record of the syndicator. How important is that, even before you get the deal, to evaluate the track record? And has your view of track record changed since we've gone through these difficult market cycle?
I'd start by saying that track record is paramount. I mean, you want to ride with somebody who's been there before, right? So the number of exits, the experience in the geographic market with the asset class, testimonials from other investors, seeing the communication style of the sponsor and understanding when they communicate and how is all extremely important. So yes, track record does matter. Has it changed? I'd say it's more evolved. I think that as the market evolves, there's unique opportunities that present themselves. and there's strategic partnerships that can form around those opportunities. I was talking with an investor just recently, maybe like last week, that was considering investment with a new group, newly formed company or LLC. So the LLC, the company, doesn't have a track record in and of itself, but if you look at the principles that are made up of that LLC, these are, four individuals that have 80 years combined experience in real estate, all very relevant to the venture that they're getting into, and all have complementary skills where if there's a gap in one person's resume, there's somebody else that's filling that gap. So to me, track record has evolved a little bit there because I'm willing to take a bet per se on a group that has that relevant experience that's capitalizing on an opportunity that may have not been present 2 years ago. So there was no opportunity to create that track record. Now you also see track records that were built between, let's say, 2014 and 2020, where everything was going right. And there could be a lot of exits and there could be a lot of success that happened during that time, but the macro forces were providing a huge tailwind to these operators. So there really wasn't much in the way of asset management happening. It was more of, can we acquire, can we raise capital, and then can we dispose of this property as fast as possible? And if they could do those things, they were going to have success. So not to say that's easy to do, but definitely a little bit more of a difficult environment we're operating now. We're understanding how to actually operate a property and improve operations and make it run efficiently because the margins are thinner. It's much more important today to have that.
Then once you've kind of picked your operator, and I'll start with you on this one, Paul, what's the due diligence process for actually vetting a deal? And what are some specific deal metrics that you might look at for a typical syndication?
Well, as you alluded, it starts with the sponsor. So ideally, you've been on the sponsor's distribution list for a couple of years. You've had that initial conversation. You've gotten somewhat comfortable with what they have to say, their thesis, how they communicate, et cetera. Maybe you've even invested with them. So you're fairly comfortable in whatever deals they present as far as it meeting your investment goals and risk tolerance. But if you get into the underwriting and the deal metrics, we look at due diligence as like a 3-step process. So first, there's the back of the napkin. We get the OM, we review it, we see, is this interesting? Does this opportunity offer a unique story and a high margin of safety with a very good opportunity for success? If it passes that, say, 10 or 15 minute due diligence test, then we get the underwriting file itself. I will say as a red flag, if the underwriting is not made available to you as an investor, but the sponsor is expecting you to write a $25,000, $50,000, $100,000 check, to me, that's an automatic. I put my hands up and say I'm not interested because I'd like to understand, how sophisticated of an underwriting model are they using? How accurate are the inputs that they're putting into the spreadsheet that lead to the outputs? Going back to some of the metrics that Jay had talked about, IRR, cash on cash return, equity multiple, those are all great, but those are all derived outputs. So I want to understand what inputs were put into the spreadsheet that got those numbers on the pro forma in the first place. And then we look at a secondary layer of metrics like yield on cost, IRR partitioning, which is essentially how much of the deal is the cash flow versus the actual exit. So how much needs to happen on the pro forma to come true for this deal to work out versus how much cash flow is going to be paid out over the course of the deal. If it's more cash flow, it's a little bit of a safer deal. If it's more based on assumption, there's very little cash flow. It's more based on projections and things that are going to happen out into the future. We look at break-even analysis too. If everything goes wrong and there's occupancy issues and you still have debt to pay, how far can the income drop before it becomes a problem where the borrower, i.e. the sponsor, can't meet their debt obligations? So the underwriting comes into play at that point. And then if it passes that test, we go into more of a deep dive. That's layer 3 of deep due diligence for us. And that would include, and I encourage every limited partner to look through the operating agreement, read it thoroughly, understand the partnership structure. If you don't understand it, ask questions. If you still can't understand it, that's not a good thing. If you can't understand what you're investing in, you shouldn't invest in it. Read the private placement memorandum and understand the risks that are highlighted in that deal. Get background checks on all the sponsors if you don't know them personally or don't have references that have had experience with them. And then you could even dig a layer deeper than that and get third-party reports like insurance quotes, property tax reassessment consultant reports, lender term sheets. In certain cases, if it's a commercial real estate deal, lease agreements, corporate guarantees, personal guarantees, things like this. You can really peel back the onion quite a bit. And, for most, it's not necessary to go that deep, I would say. But definitely understanding the underwriting file, the sophistication behind it, who you're dealing with. Is this somebody you want to get in a relationship long-term is one of the ultimate questions you have to ask, because these are not liquid deals. So if it's 3, 5, 7, 10-year holds, you're going to have a relationship with this person long-term. And if you don't like them or you can't stand them, that's probably not something you want to get involved in.
Yeah, and one thing I would like to talk about, you went into detail about the underwriting file and some of those other things that you look at, and I just want to remind our listeners that we have two very experienced investors here, and for newer investors, it is important to ask for the underwriting file. It is important to look at those numbers, but that's where the power of a community like Passive Pockets could come in and have other people who are able to help you kind of determine and dig into that a little bit, because part of what I do is in vetting the sponsor. That's part of where I rely on the sponsor to do the underwriting, and then I just do my kind of check to make sure, yep, everything looks in line. So it's great advice, but for all investors are not going to be able to dig as deep into it as you did.
I want to add something because I think this is important. And let me start with every single word that Paul said. I absolutely agree with. But I do want to add one thing. Certainly vetting the operator is literally the most important part of the due diligence process. It's not the only part, but it's the most important. And here's one of the reasons why. As a GP, as somebody that actually puts these deals together, I have kind of a different perspective on what goes into the underwriting and what goes into due diligence and what goes into determining if a deal is good or not. And one of the things that I've realized, and I hate to say this because I don't want to scare people, but the reality is that a bad actor, somebody who wants to trick you or steal your money or manipulate you, is probably going to be able to do it through manipulation of the underwriting. And just to use an example, I mean, we're all familiar with Bernie Madoff. Bernie Madoff is a guy who ran a Ponzi scheme for 25 years, stole $65 billion. And you might think, well, he must have had some pretty stupid investors to lose $65 billion on a Ponzi scheme. But the reality is that the SEC stepped in and looked into what he was doing and didn't find the red flags or didn't follow up on the red flags. And the stock exchanges followed up on what he was doing and didn't see the red flags. And some really successful and smart business owners, entrepreneurs, and investors had some concerns and looked into them and didn't see all the red flags. So it's just a testament to the fact that somebody that wants to rip you off is probably going to be able to do a lot of things to get around what an underwriting model might show us. And I like to say that no matter how much experience I have, and I do have a lot of experience, I could look at somebody's underwriting and they could probably pull the wool over my eyes if they wanted to. And so the single most important thing to me when vetting an operator is really finding somebody that is a good person or a good team, trustworthy, and that has a good track record. Because again, that's more important than looking at any particular numbers on the underwriting or any particular other due diligence pieces of the checklist. It really is making sure that you're investing with somebody who is a good person that has their investors' interests at heart. And the best way to do that really is just to find somebody with a good track record, talk to their previous investors, check and make sure that, I mean, if you have to do a criminal background check, we've had investors do that on us, and we've considered doing that on some people in the past. Don't hesitate to do whatever you need to do just to make sure that the person you're investing with has a good long history of reputable business.
The next question I'd like to ask is about cap rates. Keeping in mind the current investing climate, can you talk about cap rates and how those factor into your analysis of a syndication deal?
Certainly cap rates are something that have impacted syndication over the last couple of years. We've seen interest rates go up. Interest rates have gone up because there have been concerns about inflation and other parts of the market. That's driven cap rates up, which have driven values down. And so over the last couple of years, what we've seen just with the craziness in the market, especially in commercial and multifamily, we haven't seen this necessarily in the single family market, which everybody looks at and they can see is just going up, up, up. In the commercial space, things have been going down for the last couple of years. And it's because cap rates have been going up. What we need to look at moving forward as LPs is that we need to ensure that the GPs, the folks that are providing these deals, are being realistic about the cap rates that they're projecting. And when I say realistic about what they're projecting, I also mean they have to be realistic about what the cap rates are today. So, for example, if I were to buy a property that's generating $1 million of income in my market, and I thought that the cap rate was 5% right now, that would equate to a $20 million valuation of that property. If I thought the cap rate was 4%, which is not too far off from 5%, that would equate to a $25 million valuation of that property. Not knowing if the cap rate is 4 or 5% or where it lands in there is basically a difference in value on that property of $5 million. And so it's really important for me to know what that cap rate is in that market for that type of asset today. And for any given operator, a lot of them don't do the due diligence that they need to do to figure out exactly what that cap rate is. You can ask a property manager, they might give you one answer. You can ask an appraiser, they may give you another answer. You can ask a broker, they may give you another answer. The problem is they're not necessarily any of them lying to you, but it's a very difficult thing to ascertain. And so what you want to see as an LP is that your GP in the deal is being very conservative on what they're assuming the cap rate is today. Additionally, because the cap rate is what's going to determine the value of the property when you sell it in 3, 5, 7, 10 years, you want to make sure they're being very conservative about what they expect the cap rate to be into the future. Good rule of thumb is that as a GP, when we put together these deals, we do our best to find out exactly what the cap rate is today. And then we assume that when we sell the deal, when we put together the underwriting assumes that when we sell the deal, the cap rate is higher, meaning values have gone down. That's the conservative approach. And so typically what we see in this business is for every year that we plan to hold the property, we assume the cap rates have gone up by either 0.1% or 0.15%. So over 5 years, we assume cap rates have gone up somewhere between 0.5 point and 0.75 point. That's being very conservative because, again, that means that we're assuming over 5 years, values in commercial real estate have dropped in general. And so that's what we want to see because we don't know where cap rates are going. And so being conservative is what gives us the best opportunity for getting into a position to make a lot of money. If we're wrong and things go better than what we're assuming, great, we all make more money. But if we're aggressive on that assumption and we're wrong, well, then we potentially lose a lot of money. So if you're investing in a deal, you want to ask the sponsor, what is the current cap rate in the market? How did you figure out that cap rate? Who did you talk to figure out that cap rate? And what do you expect the cap rate to be when you sell? And assuming the operator says that they expect the cap rate to be higher when they sell, hopefully somewhere between 0.1 and 0.15% per year higher, that's relatively conservative. And that's what we like to see. If an operator tells you that the cap rate's going to stay the same over the hold period or go down over the hold period, that's probably more aggressive than I'd be comfortable investing in.
We have to take one final break, but make sure to stick around. You won't want to miss what's next. Pocketeers, welcome back to the show. Paul, when you're looking at a pro forma, we talked a little bit about that, but how do you figure out if it's realistic given the current market conditions and everything else when you're taking the numbers and kind of looking at the underwriting? How do you know that the operator is being realistic?
It's a combination of factors, and it starts kind of with that underwriting file, I think, to really understand what those inputs are. And I'd echo Jay's sentiment there on cap rates. And if you can get that file and you can kind of stress test that exit cap rate and see what happens when you move it up or down and how that impacts your results as an investor, that's extremely powerful. Ideally, there's a sensitivity analysis either on the offering memorandum already, or it's in that underwriting file where you can test different assumptions and say, okay, this is a range of outcomes. Here's a worst case scenario. Here's a best case scenario. What does that mean as far as impact on my returns? But to validate that information, this is a team sport, really, even as a limited partner investing in commercial real estate or multifamily real estate. So having a network like Passive Pockets, where you can rely on other investors who have experience in the market and know that market. If you want to invest in Atlanta, for example, but you don't live there and you don't know much about it, it really starts with understanding the fundamentals of Atlanta. What's the supply and demand look like? Are there a lot of deliveries, a lot of apartments being built, for example, for using multifamily as the example? And what kind of strain is that putting on existing product and rents? What kind of rent growth have they experienced over the last 3 years? And what does that look like over the next few years? If the underwriting file, the pro forma shows that rent growth is at 3.5–4% next year, the year after, the following year after that, that's not historically in line with what's happened. And that's probably an aggressive assumption. So what we've seen as of late is that top line expenses, or top line growth, I should say, with rents growing, that's actually come down quite a bit, even gone negative in some markets. So the top line is shrinking. The bottom line, from the bottom up, you got expense growth. So there's been increases in taxes. There's been increases in insurance premiums. Pretty much every expense related to property management, maintenance, labor, supplies, materials, all this stuff has gone up in price. So really the P&L is getting compressed. And if you've got assumptions that show massive growth on the top line and expenses staying the same or flat or even going down, that's usually a red flag. So I'm always looking for ways to poke holes in the pro forma and find where that part of the story doesn't connect to the business plan. The exit cap assumption, showing that, you're actually getting a reduction in the exit cap over the whole period is a red flag. I've seen a lot of sponsors say, well, we're at peak rates right now. The Federal Reserve is lowering the federal funds rate. So that's going to directly correlate to interest rates. They're going to come down. So cap rates are going to come down too in 5 years. That to me may happen, but do you want to count on that as far as your investment dollars are concerned to panning out? Not really. So I'd say it's a combination of factors, just really being, rooted to common sense, talking to other investors. I've even gotten on the phone and called brokers and acted like I'm an active investor, that I'm interested in the market. I want to know, what are the cap rates for A class, B class, C class properties for stabilized product? What are people paying for value add deals that have a lot of meat on the bone for a basis? What are people paying for A-class properties? What's the price per unit for each one of those classes? It's all about getting an education and understanding what the baseline is and then kind of comparing it to what the operator has in their numbers.
To throw an example there, we talked about cap rates being kind of one of the most important numbers and assumptions that the GP makes. The second, or equally as important, is the income numbers, the income and the expenses. And for many years, what we were seeing prior to 2020, 2021, was that on the underwriting, it was pretty safe to assume rent growth every year was going to be somewhere around 3%. So starting in year one, 3%, 4%, or 3%, 3% every year. And expense growth was probably somewhere around 2% because that's what inflation was back then. So you would see on the underwriting every year, 3% across the board, income growth, 2% across the board, expense growth. Unfortunately, I still see that a lot today. But the reality is that, one, on the income side, Paul said, look at historical income growth. Well, in most markets, we're not even seeing historical income growth this year. We probably won't see it next year. Hopefully, within the next year or two, we'll get back to historic growth. But in a lot of markets, we're seeing less than historic growth this year and last year. And so what I want to see is I want to see a lower number in year one and year two, and then ramping up to the historic rent growth in years 3, 4, and 5, because realistically, that's probably what we're going to see. We're not seeing as much rent growth as we've seen. And then on the expense side, if I'm still seeing 2% expense growth, because that was the number we used historically, clearly that number is wrong. Number one, we know that inflation is higher than 2%. If you believe the government's numbers, inflation's at 3%. So at very minimum, expenses should be growing at 3% a year. But we also know that certain expenses are growing faster than inflation. We see insurance growing faster than inflation. We see property taxes in a lot of markets growing faster than inflation. So the other thing that I want to see when I look at a deal as an LP is I want to see that the operator has split out their expenses and they've assigned realistic expense growth to the different line items. I want to see that the expense growth for insurance is different than the expense growth for utilities, for example. And if they haven't put enough thought into it and they just assign one number across every expense line item, that's probably not enough due diligence on their part for me to be comfortable.
Jay, I'd like to talk about debt. We're here in the middle of September, and the Fed just decreased interest rates. And that's obviously a big storyline, but how important is the type of debt that a syndicator chooses, and have the options and terms changed since we had the rapid rise and now a small dip?
In the multifamily world, we tend to see two types of debt. We see long-term fixed rate debt, where the syndicator locks in a loan for 7, 10, 12 years at a fixed interest rate. That rate can't change. Or they get what's called bridge debt. And bridge debt is generally 2, 3, 5 years at most in length, and that is at some floating interest rate. The interest rate can go up and down based on what's going on in the economy. Now, you might ask, why would anybody get a shorter term loan with a floating interest rate as opposed to a longer term loan? And there are a couple good reasons why you might. Number one, if you're buying a property that needs to go through a lot of renovation, if a property has a lower than 90% occupancy, you may not be able to get one of those fixed rate long-term loans. You may have to get a bridge loan with the expectation that you're going to fix the problems, you're going to do the renovation, you're going to put in better management, and then you're going to refi into a longer term loan in a couple years. And then there's another reason why we don't always use long-term fixed rate debt, even though it's an option. Typically in the commercial world, long-term fixed rate debt has very, very high prepayment penalties. And a lot of times it's not even a percentage of the loan amount. It can be related to the interest rate. So if the interest rate moves over the years, you can find that prepayment penalties for these long-term fixed rate loans can literally be in the millions of dollars. And so if you don't expect to hold a property anywhere near 10 years, you may find yourself paying a very large prepayment penalty if you were going to sell in years 3 or 5 or 6 or whatever. And so it's very important that the operator looks across a couple different axes when trying to determine what type of loan they want. Number one, they need to determine what their risk tolerance is. For a deal that can accept a little bit more risk because maybe it has higher cash flow, its break-even ratio is a little bit lower. If they can accept that risk, maybe a bridge loan's okay, especially if they don't really have another option. But these days, because a lot of LPs have gone through a little bit of PTSD with deals running into issues with floating rate debt and interest rates going up, a lot of syndicators these days are saying, I'm going to be more conservative, even if I know it's going to cost me a bunch of money in prepayment penalty, even if I know that I'm not going to get as good a rate. A lot of syndicators these days are going with that longer term fixed rate debt just to make both themselves and their investors more comfortable. And so what I would say as an LP, if you're looking at a deal, you're probably going to see a lot of fixed rate long-term debt these days. But if you see a bridge loan, if you see a loan with floating rate debt, don't necessarily run away, but it's worth sitting down with the operator and basically having a conversation and saying, number one, why do you think this is important? Number two, what is your risk mitigation strategy should interest rates go up or down, whatever it is that's going to hurt you in that situation? And how do you plan to mitigate that? And just have that discussion with the operator, because what you'll find in some cases is that yes, those shorter term loans, floating rate loans, are higher risk. But if the potential reward from those types of loans is high enough, it may outweigh the risk. And you need to decide what your risk tolerance is.
Excellent. Well, thank you for that. I'm going to change gears here. And Paul, we just had, as we talked about, we had the interest rates have been going up, or they went up real fast. Then they plateaued for a couple of years, and now we're ticking down, going downwards. What sort of deals and return profile and even asset classes are you looking at moving forward? You'd said you're heavily into debt. Well, not you're heavily into debt, but the asset class of debt, investing into debt. So what kind of deals are you looking for? What kind of return profiles, asset classes, and that kind of thing?
Good question. I would say, in general, over the last 2 years, as I talk to investors, I've been trying to educate and set the expectation that returns are going to be lower moving forward. We've seen some of the ones that had high pro forma projections, have distributions paused, capital calls foreclosed on. So I think there's a little bit of a decline in sentiment overall in the LP community. Capital's gotten a little bit harder to raise, but there's still an appetite out there, and there's still a lot of sponsors chasing a limited amount of deals that are out there. Transaction volume's kind of down, so the market is getting more efficient overall. And when you have an efficient market, returns come down. If you see a pro forma with a 20 IRR plus, I'm asking a lot of questions. I really want to understand, how is that possible today? If you're using, higher interest rate debt than there was like 2-3 years ago, and you're also being conservative on your assumptions, it's unlikely that you're ever going to be able to get to that 20% number. So I've always said if it's a 13%, 14% IRR with tax benefits and good cash flow, that's a much better deal than a 20% IRR that's held together, again, to use an analogy, by duct tape and paper clips. There's a lot of things that have to go right in that scenario. It may not be based or rooted in reality whatsoever. And I'm looking for margin of safety. So back to your question about what asset class attracted me, I still think debt is relevant. I think there's going to be, just because interest rates come down, or the federal funds rate comes down, I should say, doesn't mean that spreads are going to come down. Lenders can still command higher spreads, especially if they feel nervous about the economy, like there might be a recession. So, and I'm one of those people in the camp of, we could have a recession here coming on the horizon. I've been saying that for a couple of years, and I probably should stop saying it because I've been wrong. But eventually, a broken clock is right? Like twice a day. But it looks as if there's weakening in the labor market. There's been a ton of asset price inflation. The stock market's at all-time highs. Usually, when the yield curve starts to uninvert, as it's doing today, a recession is not far down the road. So I want to be prepared for that. So any investment I'm going to get into is going to have a high margin of safety. As it relates to types of asset classes, I still think multifamily has a great thesis behind it. There's a ton of supply in certain markets, but there's very little building going on in many of those markets today. So once those units are absorbed, let's call it in 2026, 2027, there's not a lot of stuff starting today. So there's not going to be a lot of inventory at that time period. And if you still have migratory trends trending towards the south, trending towards Arizona, Texas, those markets are going to fare just fine if you can get in today at a good basis. So supply and demand imbalances, even today in smaller markets that don't have that same population growth story, but just have restricted supply. I really like those types of markets that are stable, have good companies in town that aren't going anywhere, that aren't relying on just one industry, but could be, a little bit of a smaller market, but has a good supply and demand growth story. So those types of deals, I would say, some interesting stuff that we're looking at is flex industrial. These are properties that, might be your franchise owner that doesn't want to have his inventory in his garage or his basement and is looking for a place to store it and may need a small office space up front, a place to meet in the morning with the small team and then deploy into the field. Those are really hard to find today. There's not a lot of space for lease in those types of assets. So there's also, again, not a lot of building going on. So there's not a lot of supply. There's high demand. Those types of deals are interesting. Industrial sale leasebacks where a company, owns the physical real estate along with the business, but is looking for, capital for, different equipment they might need or other expenses that they might have that they need to raise capital for. They could sell their property to an industrial syndicator. Those types of deals are interesting where the value is created in creating a triple net lease that's 15, 20 years long. Retail strip centers are interesting to me. Ones that have, kind of like neighborhood type feels to them. Maybe it's 8 different bays, businesses that are recession resistant, that aren't going anywhere, that have, pizza shops, dentists, hairdressers, liquor stores, stuff like that do well when times are good, when times are bad, they're not going out of business. But those types of properties, if you can find value add opportunities where maybe 6 of the 8, for example, are occupied, there's maybe some deferred maintenance, but you can get in at a going in cap rate of 8 or 9% and fix those units up, get rid of that deferred maintenance and fill those empty bays with tenants. You can operate those, at a 13% or so. So it gives you a lot of margin of safety, again, when these properties are trading around 8 to get into. So unique opportunities, I'd say to sum it all up, open to different asset classes, but there has to be a story around the property and the deal.
Excellent. So, Jay, I saw you nodding your head to several of those, maybe even all of them almost. Do you have a few asset classes that you're looking at? Or are you agreeing with Paul mostly?
I'm a multifamily guy. As an LP, I invest in a few asset classes, which I'll talk about. But on the GP side, we like to focus because it can be very difficult to learn a single asset class, let alone multiple asset classes. But I will point out one thing, and I 100% agree with Paul that if you're investing in typical traditional value add multifamily, like bread and butter, what a lot of syndications are, that 13, 14, 15% IRR is exactly where you should expect to be today. But I will say one thing, and I know Paul, I'm sure he didn't mean it like this, but when he said run away from like a 20 or a 21 or 22 IRR, that's absolutely true in a value add multifamily. But keep in mind that returns are directly correlated to risk. And if you go into a higher risk asset class or a higher risk investment, you should expect those higher returns. So for example, if you're doing a new construction investment, new construction is inherently higher risk. And so you want to be compensated for that risk. So if you're doing a new construction investment, you probably don't want a 13 or a 14 or a 15 IRR. You do want a 20 or a 22% IRR because you want to be compensated for that risk because there is a higher chance of losing money. So I just wanted to throw that out there. Don't necessarily, and then on the other side as well, Paul is talking about doing debt investments, which I think is great at this point in the cycle, but I can probably assume he's not getting 13, 14, 15% IRR on those because those are much lower risk than a traditional multifamily common equity investment. And so look at the risk profile of what you're investing in. If it's a higher risk deal and you're willing to accept that risk, definitely make sure you're getting a higher projected return. But yeah, for bread and butter multifamily value add these days, 13, 14, 15% is exactly where we're seeing numbers falling. In terms of what I'm investing in, I really like the industrial flex. I'm still investing in multifamily. Obviously, I do it on the GP side and the LP side. Historically, multifamily is the best risk-adjusted returns of pretty much any asset class on the planet. We are highly undersupplied. There are some markets where we see a lot of supply coming online the last year and this year and even into next year. But a lot of that's Class A inventory. One of the things we like is the Class B inventory because we're not impacted as much when there's really high building prices. You're not going to be impacted as much by new inventory coming online because almost all of that inventory has to be Class A because you can't afford to build Class B or Class C properties these days. And so staying in the Class B segment is kind of the place I like to be. That said, I know a lot of people investing in Class A, and the thesis there makes complete sense, just not for us. And then we're doing a bunch of, and I know this is a little outside the scope of this discussion, but we're doing some business investments as well. So I know some syndicators are syndicating things like car washes and ATM funds. We're not necessarily looking at those, but some other business investments as well that can be syndicated. We like those as well because it allows us to diversify outside of real estate, but still remain passive and invest in, again, something I personally know pretty well.
Great. Well, thank you guys. This has been such an informative episode. It has been fantastic. I will put in the show notes if people want to connect with you, but the best way maybe to connect with you is for them to join Passive Pockets because both of you are members and you're on the website there so they can connect directly there. But thank you so much for being on the show.
Thanks, Jim.
Thanks for having us, Jim.